Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. It is pretty clear what the story is in the equity markets today by simply looking at the distinct messages coming out of the other financial markets. That is, the credit, dollar, and bond markets together tell us the story. We will look at these markets in this session, but in the context of being a mid-year update to our year beginning Under the Lens video on our macro themes for 2022. I show here the year beginning agenda with the 6 macro themes we discussed at that time. We also discussed in our long wave video investment themes for 2022, highlighted here in red. As you can see, our discussion today on the credit, dollar, and bond markets addresses the areas highlighted in both the investment themes areas and 2 of the macro themes. These are also highlighted by the red box. However, I think you will see as we go through the slides we have prepared, you will see that there are major overlaps and ramifications to the other macro and investment themes highlighted in the lower red box. You'll see this as we go. As such, we will cover the areas shown here for your reference and roadmap. I have used this analogy of a dog before and feel it is particularly important to revisit it at this time before wading into each of these market messages. Many animals detect food and enemies with their nose, which is prior to them actually seeing them or hearing them. It is in my experience that financial markets are similar. The credit market is like a dog's nose. It smells things before the other senses are aware. The bond market, like the dog's ears, and the currency market are like the dog's eyes. They quickly then focus on what the dog's senses first detected. Equity markets are like the tail on the dog, emotions wagging back and forth. The tail, when alerted by the senses, then either keeps wagging or suddenly stops. The emotional tail is the last reaction in what I will call the awareness function. The awareness function has changed noticeably since the U.S. came off the gold standard in 1971 and made the U.S. dollar a fiat currency at that time, pegged to nothing other than the credit and faith of the U.S. government. A fiat currency removes the pillars that sound money rests on. In a fiat money system, credit expansion and business activity become inseparable. It is impossible to grasp the meaning of the idea of sound money if one does not realize that it was devised as an instrument for the protection of civil liberties against despotic inroads on the part of ever-expanding governments. Ideologically, it belongs in the same class, in my opinion, with political constitutions and bills of rights. So wrote Ludwig von Mises in The Theory of Money and Credit in 1912. He further said, and I quote, "The sound money principle has 2 aspects. It is affirmative in approving the market's choice of a commonality used medium of exchange. It is negative in obstructing the government's propensity to meddle with the currency system." End of quote. Against this backdrop, modern-day monetary systems appear to have been drifting farther and farther away from the sound money principles in the last decades. In all countries of the so-called free world, money represents nowadays a government-controlled, irredeemable paper or fiat money standard. The widely held view is that this money would be compatible with the ideal of a free society and conducive to sustainable output and employment growth. Stock market performance, as a consequence, has become inseparable from fiat money expansion. Milton Friedman stated, and I quote, "The world is now engaged in a great experiment to see whether it can fashion a different anchor, one that expands on government restraint rather than on the costs of acquiring a physical commodity." End of quote. End of quote. Irving Fisher, evaluating past experiences, wrote, and I quote here also, "Irredeemable paper money has almost invariably proved a curse to the country employing it." End of quote. The primary cause for concern rests on a key characteristic of government-controlled paper money, the system's unrestrained ability to expand money and credit. In contrast, under the freely chosen gold standard, money, that is gold supply, was expected to increase as well over time, but only in proportion to how the economy expanded. That is, an increase in money demand brought about by an increase in economic activity, would bring additional gold supply to the market by, for instance, increasing mining, which would become increasingly profitable. As such, the gold standard put an automatic brake on money expansion. The latter would be, at least in theory, related to the economy's growth trend. The government-controlled fiat money system has no inherent limit to money and credit expansion. In fact, quite the opposite holds true. Central banks, the monopolistic suppliers of government's money, have actually been deliberately designed to be able to change money and credit supply to actually any amount at any time. We have witnessed since the 2008 financial crisis that the stock market has tracked precisely the money stock and Federal Reserve balance sheet growth. We have highlighted this endlessly. This is about to change, however, or at least the Federal Reserve wants us to believe this with the Fed's stated plans for quantitative tightening, QT, rising rates, and a reduced balance sheet. The markets, frankly, don't believe them, and I'll show that in a second. So let's start with what the credit market is telling us, and then proceed from there. Most of our subscribers are well aware of this high-yield bond chart. We started featuring it just after the Federal Reserve announced it had sold all of its corporate bond holdings, originally purchased under the SMCC COVID facility, where we labeled "Watch for Deterioration Rate" in the box at the top. We said to watch for death crosses of the 50, 100, and 200-day moving averages, all crossing to the downside. After the 100 crossed the 200-day, it in fact was bombs away. This is a classic waterfall chart of a market collapsing. It is reflective of the magnitude of problems in the corporate bond market, both for high yields and the investment grade at the CCC level. We'll come back to the high yield chart in a moment. Here is the chart of the low end of the investment grade corporate bonds. Note what are called the CCCs. CCCs are out across 12% after 7 straight weeks of losses. The funding window has shut down. Per Bloomberg, this month is on track to be the slowest May since the global financial crisis of 2008. The year-to-date volume stood at $55.3 billion, a drop of 75% from the comparable period last year. Quality names are taking a beating. The average investment-grade corporate bond spread is at 150 basis points, the highest since July 2020. Credit markets are in reality actually having a veto on the Federal Reserve's stated plans. They don't believe them, nor are they reacting to them. The Fed itself is now staring down 2 barrels. One, accept the higher level of normalized inflation, say 4 to 6%, slower growth, stagflation, or blow up the global financial system. This is screaming buy for hard assets. What is happening is financial conditions are tightening far faster than the Fed realizes. The Global Financial Conditions Index is moving at an unprecedented rate. The Financial Manager Survey of 331 professional money managers with nearly $1 trillion in assets under management, which I follow fairly closely, is now reporting having cash holding levels of approximately 6%. These levels have not been seen since the dot-com bubble crash. This is a sign of sincere fear. This is because financial market stability indicators only continue to rise. It is shown here with more risk being negative. We are now lower than at the bottom of the 2008 financial crisis. This is the high yield chart I just showed, but taken within a larger view. We clearly see we still have potentially a lot of room to fall much further. Switching to sovereign U.S. Treasury notes and bonds, which are considered the benchmark for risk-free, though they are currently only rated AA, we get to see the problem even closer. Yields on the 10-year U.S. Treasury have gone parabolic, as shown by the heavy dotted line. We recently approached highs in yields not seen since the highs in October of 2018 before pulling back. This indicates a serious shortage of demand as foreigners are increasingly stepping aside from purchasing U.S. Treasuries. The biggest holder of U.S. Treasuries has been Japan, who currently is restricted from buying U.S. Treasuries due to prohibitive hedging costs required for the Japanese carry trade process that is the key driver of the Japanese purchase of U.S. Treasuries to operate properly. This, along with increasing de-dollarization, driven by the weaponization of the U.S. dollar through sanctions, And the decreasing role of U.S. exports of goods around the world is increasingly decreasing the actual need for currency reserves to be held in U.S. dollars and therefore U.S. Treasury instruments. The dramatic increases in U.S. bond and agency rates is now crippling the U.S. mortgage market, leveraged loans, and much of the collateralized loan and debt obligation markets. This takes us to the U.S. dollar, which, like the U.S. Treasury yields, has gone off the charts parabolically. It has been a long time since we've seen the U.S. dollar rise like this. Amidst the backdrop of raging consumer price inflation, something strange and unexpected is actually going on here. The U.S. dollar has become more valuable, not against goods and services, but rather against foreign currencies. For example, the U.S. dollar index, which is a measure of the value of the dollar relative to a basket of foreign currencies, recently crossed the 105 level. This marks its highest level since December 2002. Not since the tech stocks were in full meltdown in 2002 has the dollar been so strong. Without question, the dollar has had quite a run. The dollar index increased over 6% in 2021. So far in 2022, it has already gained over 7%. And for the time being, and despite short-sighted dollar weaponization policies, the dollar is preserving its reserve currency status relatively well. The dramatic rise in the U.S. dollar has been a direct result of a global flight to safety, in my opinion, due to an unusual concurrent collapse in the three major global FX currency reserves besides the U.S. dollar. Extreme weakness in the Japanese yen, extreme weakness in the euro, and extreme weakness in the Chinese yuan. In the mid-1980s, for instance, the dollar index hit 164. Of course, the world was much different back then. The euro didn't even exist. It seems unlikely the dollar index could hit its old high from nearly 40 years ago, but it does seem likely the dollar could hit parity with the euro for the first time in 20 years. Slow growth and high inflation in Europe could continue to be a drag on the euro. In addition, the Russian-Ukraine war and the resulting supply chain disruptions to natural gas and oil imports in Europe points to a continued weaker euro-dollar ahead, even despite the potential for a short-term rally from support levels here. So what are we left with? Somehow, with all its faults, the dollar is perceived to be an interim safe haven asset. Somehow, with its 75 basis points in rate hikes this year so far, the Federal Reserve is perceived as being hawkish on inflation. Somehow, the dollar and the dollar-based investments have become attractive to foreign investors. But what's really going on? You've likely heard the well-worn metaphors. The dollar's the cleanest dirt in the dirty laundry basket of fiat currencies, or the dollar's the best house in a bad neighborhood. Does that really explain what's going on? Maybe, at least for now, it offers a partial and insufficient explanation, frankly. As I just showed, the euro is haggard, and with the war in the Ukraine is feeling the economic impact the most severely. The energy problem appears to be nowhere solved and has serious long-term structural problems. But it's not just the euro. In Japan, the situation is quite different. Inflation is just 1.2% compared to 8.3% in the U.S., following the simultaneous meltdown of the Japanese Nikkei and the Japanese real estate market in 1989, the Bank of Japan has tried just about everything to compel inflation higher. The Bank of Japan has tried policies of unlimited bond buying. It has also pumped massive amounts of printing press money into Japanese stocks via exchange-traded funds. It has splattered the countryside with concrete under the guise of public works spending. For its efforts, the central banks have driven the Japanese debt to GDP ratio to over 250%. Still, inflation has remained elusive. Thus, since the Bank of Japan wants higher inflation and is unlikely to hike interest rates like its cohorts at the Fed, the Japanese yen is staying comparatively weak against the dollar. That's the popular story, at least. The rationale, no doubt, is rather suspect. At the same time, Beijing's control-freak zero-COVID policies have transformed the Chinese yuan into panda turds. For these reasons and many more, the U.S. dollar is in high demand. The whole thing seems rather farcical. On a relative basis, the dollar may be strong, but it still seems doomed in the long term, just like all fiat currencies themselves. What all this is translated to, in the dog's tail or the equity markets, is a major weakness and rotation. Corrections are considered as drops of over 10%. Bear markets are considered underway with drops of over 20%. We have seen year-to-date a correction of over 10% in the Dow Industrials, now down 14%. But we have 3 in the bear market category of over 20%. The S&P 500 is down 20.2%, the Russell down 28.7%, and the NASDAQ, leading the rush downwards, is down 30.5%. U.S. equity investors have lost somewhere between $3 and $5 trillion so far this year. The FANGs, or major techs, have already lost over $2 trillion of that total. We are witnessing defensive stocks, or value, outperforming cyclicals as the ratio tracks a declining ISM manufacturing index. This chart of the S&P 500 we have highlighted over the last couple of years as a very clear head and shoulders topping formation that was developing. We have now broken through the neckline on the right and appear to be finishing a kiss of death touch of the red neckline before actually heading lower, much lower. Clearly, it is time for everyone to be prepared for a potential waterfall event in the U.S. equity markets. What are the conditions here besides a looming potential waterfall event? Well, we are waiting on something big to break and capitulation and redemptions to begin in a big way. The Financial Manager Survey sees monetary risk from the central banks to be the biggest potential risk to financial market stability going forward to an unprecedented degree. The Fed has proven itself over and over and over again to misjudge financial conditions and financial stability risk. They routinely overpromise and underdeliver because they are frankly academics who have never taken professional risk, never actually sat in a risk-taking seat, and are far more comfortable talking up meaningless, backward-looking economic data. Their pawns on Wall Street only embellish the endless lies of BS. If you measure credit risk, counterparty risk, and financial plumbing conditions in a very short period of time, if what has been transpiring over the last week continues, the Fed will break something. We were lectured 25, 25, 25, then it was 50, 50, 50, then 75, 75, 70, all while telling us to expect $1 trillion of quantitative tightening in the next 12 months. This will never happen. This is also a total BS overdose. The Fed must use hot air and their pawns effectively in Wall Street, because in reality they cannot achieve anywhere near what they are selling in their sales pitch without creating another Lehman-like event. If history is any guide, the Federal Reserve rate increases will soon cause a major event failure, and they know it. We believe that event will occur when the Fed funds rate is between 1.25 and 1.5%. It could be slightly higher, but not much. Guggenheim Investments, who do great work in this area actually, see it at closer to 1%. This would then be as close as the next Fed rate move. Redemptions will soon follow as the public hits the sell button to unload their ETF holdings. That is when the real action begins. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and frankly, global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. This is a different era. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2022 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.